This is dividend growth investing for everyone. I am so excited today to discuss 3 stocks. These stocks are McDonald's, Google, and Altria. In addition to discussing those 3 stocks, I'm going to answer a ton of subscriber questions. Thank you so much for the questions coming through. I am on my way home right now from Sacramento, California, back to the Bay Area. I stopped here at this local park in Dixon. I love Dixon. I always stop here. It's so convenient, right off the highway. I always stop here for some Starbucks coffee. And so I'm so excited after grabbing my coffee to vlog here today. I want you to ride with me on the way home today like Nelly. I'm going to be making some stops, doing some vlogs, talking about what I talk about best, and that is dividend investing. So let's get started. All right, everyone. So first topic, I want to talk about McDonald's because I get questions all the time on my Facebook group, which I'll link to in the description below. I want to talk about McDonald's. I get questions about valuation in particular. When is a stock overvalued? When is a stock very expensive? And so personally, the way that I determined if something is overvalued or not is I really like to look at the PE ratio, and I like to look at the PE ratio to where it has been historically. And right now, McDonald's, it is trading at a really high PE ratio. I also like to look at PE ratio, price earnings ratio, in comparison to earnings growth. And so I want to look at actually 2 stocks now. I want to look at McDonald's and also Google. I'm going to share some stats on the screen with all of you today that I just put together when I was over at Starbucks. And what you can see really quickly through these stats is that McDonald's right now, it is actually trading at a premium as compared to Google. It's really fascinating. And so McDonald's right now, the price per share is $210. Google is at $1,220. And I look at the EPS forecast, earnings per share. I look at it for 2019 and 2020. I pull this information, these forecasts from Yahoo Finance, and I pull them from the analysis tab. It's the consensus analyst estimate for 2019 and 2020. And basically, what I want to just look at, what I want to gauge at first is what is the forward PE for 2019? What's the forward PE for 2020? Well, for 2019, McDonald's is at a forward PE of 26, and for 2020, it's at a 24. By comparison, Google is at a 2019 PE of almost 25 and 2020 of 21.87. Now, 21.87. Now, these forecasts are obviously based on the fact that, hey, are the analysts correct or not? I'm basically assuming that the consensus analyst estimate is pretty close. I would say it's more or less pretty close for companies of this size that have this amount of analysts following them. There's a lot of analysts following these 2 companies. And so what you see off the bat is on a PE ratio perspective, McDonald's is trading at a more expensive PE than even Google. And here's what gets even more interesting. When I look at the 2019 EPS versus 2020, I just apply a growth rate. How much is the EPS, earnings per share, growing year over year? When I look at the future, when I look at what the analysts are saying for 2019 versus 2020. And basically, McDonald's is growing at 9%, but Google is growing at 14%. So both companies are growing really quickly. Both are growing strong. I like to see that. But what's interesting, there's a disconnect here is that McDonald's is trading at a higher PE ratio, but with lower earnings growth. And Google is trading at a lower PE ratio on a forward basis, but with higher earnings growth. And so what I see off the bat here is on an apples to apples comparison, which is really hard between these 2 companies, because quite frankly, I would say maybe McDonald's carries less risk, and less risk warrants a higher PE. Hey, it's a real estate company. They have the real estate locked up. It's a restaurant company. Everyone needs to eat. And now they're actually a little bit of a tech company, so that's why I'm making this comparison as well. But quite frankly, McDonald's, maybe it deserves a higher PE because it's a less risky company. That being said, just seeing McDonald's at a higher PE than Google, I've not really seen that before. It's not really been something that, well, look, I don't follow Google that closely, but it's just so interesting to see that it's trading at that kind of premium valuation. Now, on a dividend basis, McDonald's pays $4.64 per year, and the yield is a 2.21%. Now that 464, that's if I sum up all the quarters. They actually pay quarterly. That's what it would be annualized. The starting yield is a 2.21%. Really low starting yield for McDonald's. The last increase, though, on the dividend was 15%. This was a huge dividend increase, so it shows that McDonald's is very confident in their company, and the compound annual growth rate for McDonald's dividend for the last 5 years has been a 7.4%. So McDonald's is growing very quickly here on a dividend basis. Now, on a comparable basis, Google doesn't pay a dividend, so I can't compare them here. But basically, what I'm trying to point out is right now, for my personal portfolio, I am reinvesting dividends on McDonald's because I don't want to penalize a winner. It's my number 3 favorite stock of all time. But look, it's really expensive here. And so someone was asking on the Facebook group, Ian, I like McDonald's. What do you think about it here? Is it a good value or is it any kind of value? Personally, I don't think it's a value. It's not any kind of value. It's overpriced. And I just see this. Sometimes it's really helpful for me to compare McDonald's to other companies, not only in its industry, but other industries. And that's why I did this Google comparison, because Google, you would think, if any stock deserves a really high PE, it's something like Google. It's growing really quickly. And look, I love Google. I don't own any shares of Google. Maybe one day I will, but without Google, we wouldn't have YouTube here. We wouldn't be having this conversation, so I love Google. And anyways, though, this comparison I thought was a really fun comparison to do. And so take-home exercise is if you're trying to kind of understand value of companies, you may want to make comparisons, even ones that don't seem obvious, like McDonald's versus Google. And certainly I like to look at PE ratio, but I also like to look at a PE ratio in comparison to growth rate. Some call it the PEG ratio, PEG, price earnings growth, and so they'll take PE and they'll divide it by growth rate to try to compare it that way. And so that's essentially what I'm doing here. I'm looking at PEs as compared to growth, and certainly Google, not adjusting for risk, is at a better value here. Now, why am I also bringing up McDonald's and Google today? Funny you ask. McDonald's is a tech company, in my opinion. They're a tech company, they're a real estate company, and they're a food and beverage company. Let me explain this. McDonald's just made an acquisition. They announced this, I think it was yesterday actually. They announced they're buying a company called Apprente. Apprente works on voice analysis, voice-related systems. So when a customer is ordering from a company like McDonald's at the drive-thru, it can recognize what the customer is saying. It can do AI on it. It can kind of analyze it and optimize voice conversation that is happening. Now, worth noting, McDonald's made another technology acquisition recently. They bought a company called Dynamic Yield. And this is a personalization company, and so what it can do is analyze what other customers have ordered, can analyze what a customer is ordering, and it can optimize menu, offers, selections for each customer. So I thought that was really cool. It's all about personalization. And by personalizing the experience to each McDonald's customer, McDonald's will be able to increase same-store sales. They will be able to increase their sales on a same-store basis and on a per customer basis. So that's going to be really exciting. And they also invested in a company called Plexor, which makes apps. And so McDonald's is focused on their mobile apps, on their mobile ordering as well. And so what all of this tells me is McDonald's also, I read in the news somewhere that they're opening a Silicon Valley innovation technology office, which I love because I live in the greater Silicon Valley. And so basically what I love about McDonald's is they're forward thinking, they're thinking about the technology, they're staying ahead of things, and I'm really excited about that. And the reason I'm bringing all this up is, look, they're probably overpaying for these acquisitions. Some of them won't work out. Some of them, who knows, they paid a lot of money for nothing. But at the same point, what they're trying to do is they're trying to stay defensible, they're trying to innovate, and this gives me so much confidence. And this is probably why McDonald's is trading at a premium, because it's a relatively safe company out there in the scheme of all the drama that's going on in the world. That being said, certainly there's always risk factors with any individual stock. And so a lot of investors ask me, Ian, why don't you own too many tech companies? You don't own that many tech companies. I have a few, but I like to look at it at a little bit of a higher level. I own other companies like McDonald's, whereas they're not pure play tech companies. They are tech companies in some respects in that they are innovating. They're on the forefront of technology. They now have a Silicon Valley innovation office. And so what I would challenge you is to go home. Every company that I own in my portfolio in some way or another should have some kind of exposure to tech and should be innovating. And I think that's the homework exercise. It's one of these qualitative factors, if you will, when you're investing. We talk about the quantitative so much, but from a qualitative perspective, one of the things that I find companies being really defensible that I really like is when they're like McDonald's and they're innovating and investing in technology. And so whereas I don't own that many pure play tech companies, all of the companies I own, or most of the companies I own, I would say in one respect or another, are innovating and they're in the tech game. And so that's something important. If you go home, you do homework, and you start just looking at companies that are failing, that are not doing so well, oftentimes I see kind of that qualitative factor out there that they're missing out on the benefits of including tech in their strategy, in their strategic roadmap. And so I always find that to be a good factor for analyzing companies as well. All right, everyone. So while I'm at the park here, I'm going to do one more segment before I hop back in the car. It's so nice here. It's so nice sitting under the tree talking about dividends with all of you. Really quiet here too, which is nice. I want to talk about Altria. It's in the news today. There's so much getting thrown at this company. I know I talk about Altria a lot, but I want to bring it up because I know a lot of you are thinking about it out there. And the purpose of this segment, so in the last segment, I talk about valuation and I share something that is a bit overvalued, if you will. And I also talk about just kind of exposure to technology and being cognizant of that qualitative factor of investing. This segment, I want to talk about something else. I want to talk about deep discount, and I want to talk about where the money is made in investing, and I want to talk about taking on conscious risk. There's no doubt about it. The media, the politicians, a lot of people in society, they hate companies like Altria right now. And obviously because of that, there's a lot of risk priced into the stock. The stock has fallen down. I'm going to share some stats with you on the screen. It's trading at $44.72. 2019 EPS is forecasted to be $4.19. 2020 at $4.49. Basically, the 2019 forward PE is looking to be a 10.67. 10.67. Compare that with McDonald's coming in at a 26, and so that's a lot different. And 2020 PE is looking to be a 9.96, so sub 10. Fascinating. The dividend is $3.36, which puts the yield at 7.51 on a starting basis. The last dividend increase, which was just a few weeks ago, was a big 5%, but the 10-year or the 5-year compound annual growth rate is even better than that. It's been coming in at a 10.1, and so 10.1%. And so why is Altria trading at such a deep discount right now? There's a lot of drama out there right now hitting this company so hard because of, I would say, one, just declining sales in their traditional business, more health-conscious consumers, fine. But what's hit it most recently is this talk about their newer products, their electronic products, through their company that they own a stake in called Juul. And there's a lot of bad news hitting this segment. I don't want to repeat what I said in the last video. I'll link to it in the description below. I talk about the fact that it's my belief that most of the major health scare issues that are happening right now in this segment are not even related to Juul. They are related to these devices that people are buying and loading with juices and liquids that they're buying on the street that contain THC. And my understanding is not all the THC is bad, but some of them are of low grade, and my heart goes out to anyone who is involved, who is facing, or who has someone in their family or friends facing these medical challenges. That's awful. But my understanding from my reading and extensive analysis is Juul and Altria are not behind this because they're not selling devices that are refillable. They're selling devices that are quality controlled at the factory and aren't refilled with stuff that's being bought on the streets. Unfortunately, this is a product, however, that has many different variations and forms, and I think a lot of people are blaming Altria for stuff they're not even involved in, for other products that people are using out there. And anyways, what's happening today, every day it seems there's such bad news. The Health and Human Services Secretary, Alex Azar, he basically said that the Trump administration is looking very closely at these electronic products, and anything that has a flavor to it, they are looking at that and they are going to consider banning it, if you will. That is something that came out today in the news. Another thing is the FDA, the Food and Drug Administration, is involved as well. They're reviewing these products very, very closely. And so there is a lot of stuff going on right now with these products. That's why Altria is trading at a PE of 10 and such a very high starting yield. I recently bought some. I'll probably buy some more, although I'm already over allocated to this stuff. I don't want to repeat myself too much here. I've talked about this at length. Just check out my other videos. The reason I'm bringing this up today is people ask me, and also This is actually inspired a little bit by a video I watched last night. My man, Dividend Grinder, I'm always going to call you Dividend Grinder. I know you changed your name, but you're Dividend Grinder to me. He did a farewell video. He's kind of taking time for himself, his wife, his family to pursue other things in life. But he brought up in his video, by the way, I want to thank him for all the support, the comments, the likes, the friendship, all that good stuff here on YouTube. But we all love you in this community, my friend, Mr. Grinder. I like your old name, by the way, too, because it is a grind. Now, he brought something up in his video, though. We do all these videos on YouTube, but honestly, is this dividend investing stuff so hard? Is it that hard, or is it not hard? And so I kind of agree with his criticism in a way that this stuff, once you master it, and all of you, my goal on this channel is I want everyone here to master dividend investing. I want this to be the best educated group of investors in the world. Dividend investing for everyone. We're 36,000 strong. We're Thug Life investors. We want to learn all of that fundamental analysis. But it's true. Once you've been doing this for a while, for a few years, I've been doing it for over 20, you master that fundamental analysis. Now, you always pick up new stuff. You kind of learn a new thing and you're like, whoa, I learned something new today. So you never stop. But at a certain point, what Grinder is basically saying is, look, you've learned it all, and it can even become boring in a sense. And he even said, like, you could get analysis paralysis. You spend all this time in the numbers, and is it really adding that much value, you know, the 100th number that you're looking at? And I agree with him to some extent, but I also disagree because I'm real big on fundamental analysis, but I hear what he's saying. But the reason I'm bringing this up is that's not the hard part of dividend investing. I'm telling you, that's not the hard part, the fundamental analysis. Everyone here is capable of it, and you will learn it. You will learn it through just investing time and picking up bits and pieces over time, and through the support of this amazing community. But I'll tell you what's hard. That's not hard. What's hard is this. What's hard is Altria. What's hard is what's happening now. Are people going to get rich buying McDonald's right now, or even Google for that matter? Yeah, some people will get rich, but it probably won't be you and me. It'll probably be the people that inherit our stocks in future generations, because the amount of time that it will take to compound that into meaningful cash flow when you're dealing with PEs of 26, that's what's hard. But will people get rich buying Altria here if things go right? If things don't go bad? Yes. And in fact, that's one of the things I succeeded with in my early days when I was investing. I was real heavy in the sin stock industry. And so this is something I just want to point out at a high level. I'm not advocating that sin stocks are the only way to go. I certainly think they carry a lot of risk. But the way I look at life, quite frankly, is what's the worst that could happen? I could lose the money that I've allocated to sin stocks. That's why I diversify. But is it even that bad? I lose 100% of my money. Yeah, that's bad, but in the scheme of things, let me share another contrasting example. Real estate investing. If you're a real estate developer and you go out and get a construction loan, did you know these construction loans tend to be recourse? But they can go after recourse, which means going after other assets that you may have in your ownership, in your possession. And so just that kind of comparison is, look, what's the worst that could happen? Altria, you lose it all. But what's the worst that could happen with a recourse construction loan, real estate development? A lot worse. You could lose all that you put into the real estate and then some. And so I'm not trying to make light of losing money in the stock market or risk, because everyone has their own risk tolerances. But I'm just saying, the way I live my life is there is just so much that can happen out there that I think sometimes in this community, in the greater investing community, people are so scared of taking on any kind of risk. And I'm just saying, just sharing my personal journey here, that's not me at least. I am in some respects a risk seeker, a calculated risk seeker, and Altria contains a lot of risk here, but I've always found that when I lean into that risk, when I use risk as an opportunity in a calculated, diversified way, that's where one can really get rich in the stock market. It's not McDonald's. Future generations will get real rich on it if it's held long enough, because time is more powerful than anything. You hold McDonald's from here on out 100 years, 200 years, hey, you're set. But unfortunately, I'm not going to be around 200 years most likely to enjoy those benefits. But with Altria, deep discount, I'm just trying to paint a picture here that risk assessment, it's part of the game. And I'll tell you the other thing, this is what's hard though. It's hard. A lot of people are scared of buying it now. A lot of people that own it, they might want to sell it because they're scared. Everyone's telling you you're wrong. Maybe it is wrong. I'm not saying it's going to work out here. I don't know. I am placing a bet on it. I do have an allocation to it in a risk-adjusted, diversified way. I don't know what the future holds, and it may not be for everyone out there, but what I'm trying to say is this is what's hard. It's like the fundamental analysis, yeah, that's hard too, especially when you're learning the ropes, but once you've got it, this is really how I want to kind of respond to Dividend Grinder's theme in his video, is that this is the hard stuff, and this is why community is so important. Not because you just want to follow others in the community, but just because you want perspectives like this. You want to hear this stuff. You want to hear what other people are doing. You want to stay strong because times do get tough. And right now, times are real tough for Altria. Man, they hate that thing out there. And I want to just kind of look. This is vlog style today. I'm just doing my thing, so I hope you guys don't mind. I want to share something, just a business insight with all of you. One thing that kind of scares me out there about this country these days is it's so hard for smaller businesses and smaller time people, because I'll tell you what's going to happen here. It's kind of like a flow chart. There's probably some kind of flow chart I can make for this. But basically you have individuals, small businesses, we're paying taxes. Where do those taxes go? We're going to government. What's the government doing right now? They're saying, hey, these electronic products are no good, so we're going to spend a lot of money. We're going to invest a lot of resources and attack them. And then what's this really going to do? I'll tell you how this is going to play out, because I know how it's going to play out. I may be wrong, but this is how I think it'll play out. What's going to happen is all the stuff, all these kind of one-off like electronic product stores. You know, you have your local store that sells these products, like right next maybe to like the adult beverage store or something. You got these stores that are selling these products. What's going to happen, unfortunately, is all that stuff's going to get regulated. A lot of those guys going to go out of businesses. It's so hard for small business. My heart goes out to you if you own one of those stores or you own a small business that face challenge. It's hard being a small business. So what happens is a small business, the individual guy, the small guy, pay all these taxes. Big government comes in. They make it real hard for these small businesses. They force the small business out. But what's going to happen, companies like Altria, they got lobbying power, they got resources. They also have a controlled product. They're going to work with the government and they're going to figure out a controlled system to produce these products. And so they're probably going to win even more market share, because it may be that Juul is the only product that survives because it's the only one the government and the FDA can regulate. And so it's just how kind of big business, big lobbying power tends to have, maybe they don't have it easier, but they tend to have, I would say, a little bit more staying power than some of the smaller guys. And this is what's so sad about this, is the politicians win off of the tax dollars. The individual guy maybe kind of wins or loses. What's sad is the government's just trying to kind of regulate freedom a little bit. Look, your average person, they're just trying to go out and enjoy one of these products on their break. Come on, like that's all they're trying to do. Now, I'm not trying to make light of the health risks, because it's very sad for people making health risks. So that's where the kind of the silver lining in this is coming, is maybe it will be better for the individual person, because they're going to face less health challenges related to these products, which is a win. So there's pros and cons of all this regulation, but it's just talking kind of philosophically here, macro level business stuff. It's just interesting how the cycle works. And if anything, I've talked about this before, so I don't want to go into it too much, but one of the reasons I diversify so much, even though I only own big businesses more or less, is this political uncertainty. There's just so much political stuff happening these days. And so it's just interesting. It's just so interesting to see what's going down. But that's how I think it'll play out. I'm not really worried. I'd probably be a little more worried if I was 100% Altria or something, but I'm really well diversified. And so the diversification is my friend. It allows me to lean into a risky situation like this and just contrast this hard situation, and it's mentally hard. I mean, anyone tells you, oh, I'm not scared at all. Everyone's scared, but you get used to it and you get past it. And so I'm just trying to say that this is what's hard. And the fundamental analysis can be hard too when you're newer, but this is why YouTubing is so important. This is why the Dividend community is so important as it pertains to dividend investing. This is the hard part of it all, everyone. And so I'll see you guys in a bit. I'm going to get in the car. I'll see you in the next segment. All right, everyone. This is Thug Life Dividend Investing. Who else is vlogging about dividends from their car on the road? That's what the Thug Life is all about. I want to answer a few subscriber questions now. I'm stopped in Fairfield here. By the way, shout out, if you live in Fairfield or Dixon or greater Rockland, Roseville area, please put in the comments below I oftentimes visit these cities, so I'd love to do a meetup in one of those cities or all of these cities one day. So please represent your city in the comments below. All right, I have a bunch of subscriber questions. I just want to go through them one by one here. The first subscriber question is from the Facebook group. It pertains to REITs, real estate investment trusts. And I own one of those. It's called Realty Income, ticker symbol O. It's the monthly dividend company. I love that company. And the question was on taxation. I had mentioned previously that the taxes on real estate investment trusts are the dividends, the distributions from them are taxed more or less at ordinary income. And so one subscriber had a question about that and wanted to understand the difference between taxation as it pertains to real estate investment trusts and your run-of-the-mill dividend stock like McDonald's, which is taxed as long-term capital gains or qualified dividends. So McDonald's, the dividends come through, they're called qualified dividends, and those are taxed at the long-term capital gains rate. For most people in the United States, that's 15%. Now, for real estate investment trusts, it's a little bit different. Real estate investment trust is a different type of company. It's a real estate company, and by definition, these companies distribute 90% or more of their income. They pass it through to shareholders that own the real estate investment trusts. And this income that comes through, typically it is going to be taxed, most of it, as ordinary income. And so ordinary income is basically the same tax rate that one would receive, for example, on job income. It's just your ordinary income tax rate. This is a lot different than long-term capital gains. And that's how most of the income is taxed on real estate investment trusts. Now, there also is a component of return of capital. And so when you receive your tax information from your real estate investment trusts each year, you're going to want to look at it very closely. And I like to personally work with a qualified tax advisor. I recommend the same for anyone out there to consult a tax professional, because this stuff, it does get a little complex, and I've always found that it's a worthwhile investment for me to pay and have a team around me who can support my investing efforts through giving the right information and preparing my taxes in a thoughtful manner. But basically, when you receive the tax paperwork, there's going to be the portion that is ordinary income, and there's going to be the portion that's return of capital. Ordinary income is literally taxed at the same rate as job income, for example. And return of capital, what it does actually is it's not taxed in the moment, but it steps down your cost basis. And so it's important to keep good records. Thankfully, most brokers and transfer agents will do this for you. But what you have to do is understand that the return of capital portion, it actually moves your cost basis down so that when and if you ever sell, the cost basis you'll have is actually less than you paid for the shares if you've held them a long time, because return of capital steps down the cost basis over time. Now, all of this being said, there were some major changes to the real estate investment trust tax code, and these changes affected the 2018 tax year and forward. And these tax changes came from what's called the Tax Cuts and Jobs Act. And what they did is they basically said, hey, on the ordinary income portion of taxes for real estate investment trusts, there's now up to a 20% deduction on that portion of the taxes. And so this actually stepped down the taxes that investors like myself owe in 2018 and beyond on real estate investment trusts. And so a lot of people are wondering, hey, why are companies like Realty Income trading so high? Hey, why are real estate investment trusts so expensive right now? Well, a lot of it is fueled by this tax change, because the tax code changed and it gave investors a huge boost on their after-tax income from real estate investment trusts, therefore pushing the prices of real estate investment trusts through the roof. And so a lot of people wondering, why are they expensive now? It's because of that up to 20% deduction on the ordinary income portion of the REIT taxes. And so to summarize, for long-term dividend investors, there are some important tax considerations with REITs as opposed to traditional stocks like McDonald's. With real estate investment trusts, there's the ordinary income component, which is you're now able to experience up to a 20% deduction on that because of the tax code change. And there's that return of capital, which steps down the cost basis, which really doesn't matter until it comes time to sell. And I'm a buy and hold forever investor, so that the return of capital portion, I look at that as a big benefit because it can optimize taxes in the short run and defer tax liability into the long run. But definitely some more complex taxes with real estate investment trusts, and that's a consideration as well. Not quite as complex as MLPs, Master Limited Partnerships, which I've done an entire video on here on YouTube. I'll link in the description below. But if you're considering investing in MLPs, definitely check out that video. There's a lot of tax stuff with those. But even with real estate investment trusts, they may not make sense for all investors because the taxes are more complex. And typically, in my experience dealing with real estate investment trusts and MLPs, it's nice to have a professional tax advisor for those types of investments. And so, really good question from that subscriber. I want to move on now to another question. This question comes down to my threshold. I shared recently that, hey, when I was just starting out, I like to invest $2,000 at a time in stocks, and I like to build up a position to $2,000 before I move on to the next position. And some investors, subscribers were asking me more about this. Again, on my Facebook group, they're kind of asking, why is that? Why did you create, Ian, this arbitrary $2,000 rule? By the way, my $2,000 rule is a lot higher now. I have another number that I follow, which will get me to where I need to be to have a position of size in the portfolio, of the right size. And so the reason I came up with the $2,000 rule, it's arbitrary, but it's a fewfold. One, it forces me to focus. When I'm just starting out, especially when I'm just starting out, it's very important to have goals. And it's very important to have capital allocation goals because it keeps me focused. It keeps the investor focused on building a position. If I'm just kind of putting money in stocks and I don't have a goal and I don't have a target allocation, I'm more likely to squander money. And so I find that very important. It helps me be more thoughtful. I think when investors are just starting out, they're kind of in this position where it's very attractive to buy a lot of stocks. Like, let's buy all these stocks. But what I've always found is there is a lot of benefit in prioritizing and owning fewer stocks. And so when I was just starting out, it's very helpful to prioritize. And by setting the $2,000 rule, it helped me be more thoughtful and pick the positions that I was investing in a lot more carefully. One thing I want to point out as well is I just think when people are starting out, sometimes they don't have big enough goals. And my goal here with the dividend, this is Dividend Investing for Everyone, 36,000 dividend investors strong. I want people in this community to think big, to have very high aspirations, to have aspirations that are in the millions, and if not in the millions, in the hundreds and hundreds of thousands, say 500,000 and up. We are winners. We are a strong community. And what I found is just by setting goals in realistic chunks, a lot of people are thinking, hey, 2,000, it's too much. I want to start lower. And you can start lower. You can start investing in dividend stocks with as little as $25 through transfer agents, in many stocks with no commissions. But what I'm trying to say is when I started out, and what I'm trying to impart on the community here is to think big. Think big. And so I'll give you an example of this. When I started YouTubing, I leave all my videos there. I know a lot of channels, they delete some of their earlier videos. They might be embarrassed by them. Check out my earlier videos that weren't even about dividends. They're about digital marketing and other stuff. Look at how far I have come. The reason I have come so far is through hard work, focus, dedication, and literally writing my goals down. I have the 5-minute journal. I write it down. I've realized my dream. And there's a rapper that I really like, and I actually posted this on Twitter the other day. Check me out on Twitter, on Instagram. I'm sharing all kinds of cool stuff. There's this rapper, AZ, and in one of his songs, he says, basically, I don't remember the exact lyrics, but he basically says, you have to kind of visualize it to live it. And I really believe in that. I like to visualize the future. And so when it comes to investing, for example, I want to set the bar high. And I just found when I was starting out, $2,000, I don't even think that was that high of a bar, but certainly I didn't want to dilute myself and buy all these stocks and kind of be running in every which direction. It was easier for me to focus, and now obviously I have 42 positions, but my portfolio has gotten really big, and so it makes sense for me to have that kind of diversification. But even now when I'm adding new positions, I have my internal goal for each stock, and I have to visualize it to live it. I have to keep pushing. I want to push myself. I want to focus. I want to prioritize. And I want to be thoughtful with the positions I add versus adding too many and spreading myself thin. And also, quite frankly, not doing the appropriate analysis. I've always found with more focus, there's more there's going to be more quality analysis because I'm going to focus on what I'm doing. And so that's a reason for the arbitrary $2,000 rule. It may work for some other folks out there. It may not. It worked really well for me, and that's why when I was constructing my hypothetical $10,000 portfolio recently, I did 5 stocks at $2,000 each, just because if I were starting over again, that's what it would be. But even if I were starting over again with $500, for example, I would basically deploy the $500, and then I would keep building the portfolio until it got to $2,000 in one stock. Then I'd move to the next one. Maybe if I was torn between 2 stocks, I'd buy 2, $250 in each, and then I build each of them to $2,000 each. But that's just how I operate. I just felt $2,000 is kind of a reasonably sized chunk. Another way of looking at it is at a 3% yield, $2,000 is $60 a year, which is $15 a quarter. I just kind of felt if I'm getting less than $15 per quarter from a stock, is it really worth even having the stock? And so that was another way to look at it. And so I just want to encourage everyone on the channel to think really big, have big goals, visualize it to live it, be like AZ, have big goals, dream big. We are winners here in this community. And so that's how I look at it. And so I want to move on now to another question. This one was kind of premium stock versus value stock. The subscribers is asking, are there different types of stocks? Like, are there cases where it warrants paying more money, paying a higher PE for a premium, quote unquote, premium stock? Absolutely. I think this goes back to the example at the beginning. I don't think McDonald's will ever be at a PE like Altria. And I don't think Altria will ever be at a PE like McDonald's. It's always going to be a gap. Maybe the 2 stocks go up, maybe the 2 stocks go down. There's always going to be a delta, a gap between the PEs of those stocks. Why? McDonald's is a premium stock. Altria is less premium because it carries a lot of risk with it. And so it's not as much of a premium stock. And so certainly when I'm targeting my buy prices, my PE ratios, I do factor in if something is premium or not. And I think it's okay to look at the market that way, to look at things as, hey, is this more of a premium stock? Is it more of a value stock that carries more risk? And so oftentimes the premium quality of something dictates the PE ratio and the buy price. Now, the only risk of only buying premium stuff is oftentimes it delays the financial freedom. And like I was talking about earlier with McDonald's, you know, at these prices especially, someone's going to get rich, but it's going to be in future generations, and in time is going to really have to work its way out there. And so sometimes consciously taking on value makes a lot of sense. And so I like to hold premium stocks and value stocks. I like to manage my risk. Premium stocks are really good for managing risk, and so that's why I like having some premium stocks. Rarely you can get a premium stock at a value price if the company runs into some challenges. I think one of those stocks that's facing such challenges right now that's historically been a premium stock is Johnson & Johnson. And so that one's trading at plus or minus PE ratio forward of 15 right now, which I would say is a premium stock, which I would expect to have a PE maybe in the 18 range, 18 to 22, somewhere in there, dropping to a 15. That's a premium stock gone on value. But there are some challenges right now, so maybe it's a little less premium than it was before. And so I think there's a spectrum on the scale of deep discount value risky to premium, ultra premium, and maybe J&J has dropped down that scale a little bit because of all the lawsuits, and so you could say it's a little less premium. Personally, I believe it's just as premium as before, but I do use this concept of premium and value, and I thought that was a good question from that subscriber, so thank you for that question. All right, so the last question today, and I do apologize for skipping around here. I've had to stop and start a bit. I'm getting tired. And I would really appreciate the subscriptions, likes, comments, thumbs up. These days it's hard to fit in the videos, but I do it. I love you guys. And so I'm making a real conscious effort here to get this video done for you all. And when I get home tonight, I'm going to stay up real late editing, getting it ready to publish tomorrow morning. And so thank you. But please bear with me. I know it's not the cleanest video I've ever done in terms of the edits and this and that, but I'm just trying to be do it vlog style, do it thug lifestyle here from the car. And so the last question today is as it pertains to target PE ratios. A subscriber is asking me, hey Ian, where would you buy Starbucks, Coca-Cola, McDonald's, and Walmart? The subscriber is saying I want to get into those. I own all of these, but subscriber is saying, like, how do you know when to buy them? Personally, I like to again look at PE ratios. They really help me. They're very different by industry. Some industries that are more premium, going back to the last question, if it's a more premium stock, it's never going to see as low of PE ratios as less premium stocks. And so Starbucks, for example, super premium stock. Is it ever going to get a PE of 13 or 10 like an Altria? No. I don't know what Starbucks PE is now, but before I publish this video, I'll put it on the screen for you all. I'm going to do it when I calc it when I get home, and I'll put it on the screen right now. But Starbucks, personally, I would feel comfortable buying it anywhere between a PE of 15 and maybe 22. And so I just have ranges for each stocks, and those ranges are just based on my 20 plus years of market experience, on my experience owning the stocks, on historical PE ranges for the stocks, on the growth rate of those companies, and quite frankly, just on the quality of those companies, on the quality of the quality of the dividend yield, the sustainability of the companies, all of that kind of stuff. But I would feel comfortable with Starbucks anywhere between like a 15 and 22. I would say Coca-Cola, pretty similar, like 15 to 22 range. Maybe a little lower than Starbucks. I don't look at Coca-Cola quite as premium as Starbucks, but I do that range, anywhere between 15 and 22. Maybe Starbucks I should go back. I'd be willing to buy it up to like a PE of 23, 24 or something like that. And so Starbucks, maybe I push it a little higher on my target PE range. Coke a little lower. McDonald's, I would say anywhere between like 16, 17 and like 22, 23. So it's again a little more premium. That's kind of my range. Walmart, personally, I think is a lot less premium, and I'm glad the subscriber included Walmart in this example. Personally, I would buy Walmart anywhere between like a PE of like 10 and 14. And so this goes to show how it differs by category. Now, the reason I have Walmart at a lower PE is it's at a lower PE range target buy, is it's a lower margin business, so it has less margins. I would say they have a lot of competition with Amazon. It's a middleman business. They're not the end brand. Yeah, they have store brand stuff probably, and they bought some brands like some tech disruptors, tech disruptive companies that are producing brands. They own a few brands, but more or less they're a middleman company. They're a store that has thin margins. I love them. I'm glad I own them, but it's the quality of the company at the end of the day, in my opinion, does not warrant the kind of PE. It's something like a McDonald's that has the real estate locked up, that has the tech innovation, that serves food that people need to eat. It's so hard to disrupt a company like that. It's such a great company, in my opinion. I just feel like it warrants a higher PE. Same with Starbucks. It is literally crowded every time I go. Everyone goes there. Everyone loves it. Younger generations love it. Margins on coffee are huge. It's growing really fast. It's starting to grow fast, not only in the US, but around the world. The whole mobile order thing is going to come to fruition and do huge things for Starbucks. So again, more of a premium company. Coca-Cola, I would say huge premium company. Yeah, there's less of an interest these days in people drinking soda. It's not that healthy. I don't drink any soda anymore. Had to stop for health reasons. I've discussed this on my videos before, yeah, soda, I don't drink it anymore. I do drink coffee. I do drink Starbucks, and I drink quite a bit of Starbucks. I'm there all the time. I would say on any given week, 5-6 days a week, and so Starbucks is my place. But anyways, Coca-Cola, they got some stuff going for them, though. They bought Costa Coffee, which is the Starbucks equivalent in the UK. I love them, and they own a lot of different beverages. Slower growth than both McDonald's and Starbucks, so that factors into my PE range as well. But the way I kind of work is I have all this stuff in my head, because I've looked at these stocks so many times. I understand the growth rates. I understand the margins. I understand the business. I understand the revenue. I understand the debt. I understand the balance sheet situation. I understand the assets part of the equation. I kind of compute it all in my head. I layer the qualitative on top of it, and I come up with my target PE ranges, and that's just how it works. But again, Starbucks, probably like a 15 to 23 range, 16 to 23, maybe 24 range. Coca-Cola, you're looking like 15 to like 20, 21, 22. McDonald's like 16 to 23, 24, and Walmart like 10 to 14. So those are kind of the target PE ranges that I would look at to get into these companies. And right now, a lot of these companies, especially the first three, I imagine, are not in those ranges. I know McDonald's is not, and you just got to wait. And so for me, I do look at forward PEs these days, especially if we're like halfway through the year, and we're kind of, now we're almost towards the end of the year for 2019. Forward 29 PE is the way I go on computing my PEs, and I just wait for a good stock sale. Now, what I love about owning 42 companies in the portfolio is at any given time, there's always something on sale. And unfortunately, it's not always the stock I want to buy, so I have to be careful. But like Altria, for example, I don't want to buy too much more. I have too much already, but heck with it. It's a good deal right now, so I probably will buy more. But there are stocks on sale in my portfolio that I do want to buy now, such as 3M. I'm really happy to add to that stock right now, and it continues to be reasonably priced. I think the PE forward right now is like a 17 or so, 17, 18. That's pretty good for 3M. I'd probably be happy to buy anywhere between like 15 and 20, 21, something like that. Now, obviously, when I put the lower bound on these PEs, there's no real lower bound. If it goes lower than that, I'll be happy to buy more. But the reason I put a lower bound is realistically, is it ever going to get lower than that? Probably not. That's why I like to have a range, just to remind myself that, hey, if it gets towards the bottom of the range, it's probably not going lower. I should probably step in, back up the truck, and buy some shares of those quality dividend companies. Great questions, everyone. Thank you so much for those questions. I love you all. Thug Life Investing. Thank you for hanging in with me today. I know it's a more choppy video, but I hope you enjoy the vlog style, get to learn about my life just a little bit more. Really excited because I have another meetup coming up in San Jose tomorrow morning, and so that's going to be a fun meetup as well, and I'm hopefully going to be able to recap it here on this channel as well. So I'll surface those insights to all of you at home who could not make the meetup. By the way, if you live in California, anywhere in California, sign up for my local crew. I'll include the link to that in the description below, because I'm all over California, and so I want everyone in California on that list, close by, people that visit California, so that you can be apprised of future meetups that happen, because the meetups, that's what this is all about. It is so fun when we get to sit face-to-face and talk about dividends, the dividend game, making money, cash flow, all that good stuff. All right, everyone, in terms of full disclosure, I am long on the stocks I mentioned today. I am long McDonald's, ticker symbol MCD, Altria, ticker symbol MO, Starbucks, ticker symbol SBUX, Coca-Cola, ticker symbol KO, Walmart, ticker symbol WMT, J&J, ticker symbol J&J, Realty Income, ticker symbol O, and 3M, ticker symbol MMM. I'm long all of those. Also, before I leave today, a friendly disclaimer. Today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out, invest in the stock market or anywhere else, please consult a licensed investment advisor first. Just sharing my journey here on YouTube for fun and entertainment. I'll see you all in the next dividend investing video.